Alright guys, so today I'm going to be giving my thoughts on this video this YouTuber made over PayPal. So I've already watched the video through and I'm just going to give some of my thoughts, some of the points I disagree with on. And given that I have I'd say a pretty good chunk of my portfolio in PayPal stock, I just kind of want to give my opinion on some things other people are thinking. And also I just kind of like getting other people's perspectives to kind of expand my knowledge, especially for my investments. So the video we're going to be reacting to is this one right here. PayPal's $15 billion buyback could change everything. This is from Dividend Compounders with Cheese. So go follow him. I'll put his channel link in the description as well if you want to go check out his channel, because he made a pretty good video right here. So I'm going to do this little intro right here, and then I'll probably skip to a little bit towards the middle to cut out a little bit of the fluff. So let's go ahead and get started.
Because this one is a follow-up. But circling back to the present tense, I just want to say I hate you guys, because you are in fact correct. And so through this video, I'm going to articulate my thoughts on how you guys helped me to change my mind. So what you see on your screen right now is from PayPal's Q4 2024 investor presentation. What you want to look at is the line item right here. PayPal's leadership team announces a $15 billion share repurchase program with no expiration date. They don't have to do it right now. They don't have to do it tomorrow. They can buy back the shares to their own discretion and whenever they please, whenever they feel like their share price is just way too low. However, what makes this even more crazy is that they still have $4.86 billion remaining from the share buybacks that they authorized in 2022. So it brings the total of share buybacks to just shy of $20 billion. And I did some digging around and I pulled it up in their 2022 10K. In June 2022, our board of directors authorized an additional stock repurchase program that provides for the repurchase of up to $15 billion of our common stock. So when you think about it, in the span of 3 years since they authorized this, they utilized about $10 billion to buy back the shares. But first, I think we need to pump the brakes because...
Okay, just going through that point right there. One thing I will say is just for anybody who's getting more into stocks or anybody who is running analysis, you should always be looking at what the share count's doing over time. This is one of the things. I don't have like a formal checklist, but I have like a checklist I run through in my head when I'm looking through new companies to invest in. One of the main things I'm looking at is what's their share count doing, because that has a real effect on your returns. So just I just suggest making sure, especially if you're doing a deep dive of a company, always looking at the diluted shares, see what they're doing, and just always keep that in mind. So right here, he just kind of breaks down how the share buyback can affect your EPS, which I'm going to go ahead and skip ahead. If you are interested in learning about that, it's not too complicated. I just look it up on Google. You could probably find it, or honestly, you could probably ask like ChatGPT or something. Anyways, so next we're going to jump over to 610 is what I had marked. This is when he was running a little valuation spreadsheet.
EPS was only going to increase by 2.4% year over year. However, now I have it at 8%.
We have got to the point where literally anybody can build a fully working app without knowing how to code.
And then the following year, 11%, and so forth. And that's because I baked in about 5% of the EPS growth being attributed towards the share buybacks. And you might be like, wait, hold on, Amos, only 5%? Why is that? Because when you think about it and you look at their past timeline and history and the behavior of their leadership in terms of how they buy back the shares, in 2022, they also authorized $15 billion of share buybacks. And going into 2025, they had just shy of $5 billion left from the 2022 number, which means they don't use all of the $15 billion in one calendar year, nor do they like using it all in general. They like having some gunpowder in the reserve. So even though as of right now, in 2025, they also authorized an additional $15 billion, I don't think they're going to use all of it right now. Instead, predicated upon their past behavior and going off the assumption that the leadership team will buy back about $3 to $3.5 billion of stock each year, then realistically about 40 to 45 million shares will be taken off the market each year. Because believe it or not, buying.
Okay. So just right there, if you wanted confirmation on that, you could also just go listen to the earnings call, or you could go through the 10Q. I believe it was in the Investor Day presentation as well. But in terms of that point right there, he is correct. They don't use all their share repurchases at once. Most companies don't when they authorize a share repurchase program like that. They typically spread it out. In PayPal's case, the reasoning they're not doing that, even though the price is low, is because they're trying to only use cash they're generating from the company's free cash flow. They're generating around like $6-ish billion a year in free cash flow, which is letting them buy back about around the $5 billion range of free cash flow. So again, he's correct on that, but I don't think he needed to go through all the steps of just seeing, okay, they authorize 15 billion, they still have 5 billion left within the year. So this is about how much they're spending a year. I think he could have just really gone to the earnings, but it's not a big deal. But just going forward, if you look at some of those press releases, most companies will typically give you an outline on what their share buyback plan is. So PayPal's been pretty transparent with how much they're buying back a year, and they're using it mostly through free cash flow, which I enjoy because I don't think they need to take out stock or any type of debt just to buy back. I don't think that makes sense. But let's continue through.
Buying back 40 to 45 million shares each year, that's going to have a drastic effect on their shares outstanding. And right now they have a little over 1 billion shares outstanding, and to buy back about 4 to 5% every year, that's going to be huge for their EPS. So jumping on back over to the EPS forecast, if they do in fact post $5.45 the next year, then realistically, I think PayPal should finish the year at $81.81. And if their EPS increases by 11%, of which 5% is attributed towards the share buybacks, then $90.81 not out of the question. And then in 2028, roughly 3 years from now, I think PayPal should be a $100 stock again. And remember, this is based on the assumption that the market will continue to feel disgusted, to feel repulsed towards PayPal and their trading multiple being 15. However, historically, their trading multiple and PE is what you see on the right side, this column right here, 28. Usually, their PE should be a 28. Now, do I see that happening anytime soon for the markets to feel bullish about PayPal again? Probably not. But to be at a 15, to be priced exactly the same as these very mature established companies with practically no growth baked in, I disagree with that as well. I feel like if the S&P 500, the average PE is above 30, I think it's like a 30.7 right now, for PayPal to be at a 15, I think that's ridiculous. I fundamentally disagree. I think their trading multiple should be closer to like a 20 or a 21 at a minimum. And even at a 28, that's still a slap to the face. But I think it makes sense because their revenue, their gross sales, it has been slowing down by a significant amount. I think their growth story, their Cinderella tale in 2020 and 2021, it came to a halting stop, and the numbers have just been kind of modest year over year. But to be at a 15 PE ratio, I disagree.
Okay, I have to push back on a few of these points. He went through just few things. First off, on the markets are pretty elevated levels right now, so I don't think you can just take a broad-based look like that and say the average market's trading at above a 30 right now, so PayPal should deserve that market multiple, because in my opinion the market probably does need a pullback. Most stocks should not be getting a price to earnings in the 30. If you're growing your income, okay, double digits, say something like Meta currently, they just did a 20% net income growth. Okay, then you can justify that 25 to 30 range. But I don't think the majority of stocks should be trading in that 30 range. I think the market should be pulling down a bit. I think average stock 15 to 20. With that being said, I think he's correct. 15 is too low, in my personal opinion, for PayPal. I would personally think around the 20-ish range is okay, but I don't think, like he was saying, they should go back to that historical 28. That historical 28, when they had that was mostly because they had more top-line growth. But the problem with that is that top-line growth was coming through a lot of acquisitions that were very poorly implemented. Like currently with the whole PayPal World initiative, they're barely getting it to where Venmo and PayPal are going to be more linked and integrated, so they aren't competing against each other, which is just insane to think about. You have two products, the same company, but you have them competing against each other. So there was a lot of acquisitions, but they were never really fully integrated into the company and work seamlessly. So currently, with part of the turnaround that management is doing, this is a lot of the issues they're trying to fix. So I don't think they should be at that 28, but I don't think they should be at the 15 either. And I guess just more adding on to his projections he has run right here. I do see, so he said he's baking in about 5% of that EPS growth associated with the actual share buybacks, which I think is fine. But currently, so that means at least in this 2026, if I'm understanding him correct, he's baking in 3% net income growth organically, and that would be 6, and then that'd be 7.5%, which I personally think is a little low, and I'm going to give my reasoning. So they're currently have their revenue growing by about 5%. But if you currently look at a lot of the initiatives that Alex Chris has been putting in over the past 2 years, a lot of it has been moving away from some of their lower margin revenue, specifically like the unbranded Braintree side, and they've been moving back in to the branded side of checkout. This branded side is a lot higher margin. And Venmo's been accelerating as well, which I think the margins are going to be better on this. You also got to factor in that they have plans to roll out for some more use of the advertising, using some of that data so they could start running ads, as well as the PayPal store they're trying to set up within the PayPal app. So I think that they're going to be other revenue generators, but even if you don't factor them into the revenue, I think it's just going to be higher margin sales that are going to push that net income margin higher. So personally, in my schedule, which I do have a video, I'll probably throw it up somewhere on screen, if not in the description, where I kind of gave my breakdown on what my projections were. But for my projections, I did bake in more EPS growth just because I believe a lot of the net income expansion is going to come from just those improving margins. But just something I wanted to throw out right there.
But between you and me, now please don't get angry at me, but I feel like PayPal, they're not exactly being wise with their utilization of their capital, because in lieu of share buybacks, I wish that PayPal would allocate more of that money towards buying out a new fintech company that's just disrupting the industry or rolling.
Okay, I just have to push back right there again. I don't think that's wise. When you have a stock at these low of prices, why not just do buybacks? You're returning money to the shareholders. At the end of the day, every time a company is buying back shares, they are increasing your ownership without you having to buy more of the company. You effectively own more of the company, and you're pushing that up and up organically. Now, he's talking about maybe try to pull an acquisition for something similar to a SoFi. I don't think that's wise, especially not with how already pulled thin the company was with all of the past acquisitions they have done. And the management has already done a good job just trying to right everything the past management did before Alex Chris and his team. And I don't think spending their capital on another acquisition that they'd have to spend more time to integrate and to interweave with the current company would be a good thing. I think right now the most effective use of their time has been what they've been doing, where they're trying to take all the acquisitions they made in the past and make sure everything works seamlessly. And after you get everything working seamlessly right there, and maybe the stock price starts to finally rise to where it's at a more fair value and buybacks don't look as attractive, then we can start looking at acquisitions of products and companies that make sense and will integrate well. I don't think they need to just go out and let me acquire something to reignite growth. We saw how that happened. We saw how that worked. We saw the stock price crash because of it, because of just going after pointless acquisitions to acquire. I don't think they need to do that. Make sure the acquisition makes sense. Make sure you get the acquisition at a fair price. But till then, just fix the acquisitions you currently have. This is a turnaround play. This isn't a major growth play. This is classic turnaround. Fix what was wrong. The stock price went to this depressed level because of a lot of mistakes past management did. So right now, it's just fixing those past management mistakes, and then we can talk about growth after that. But right now, they need to be focused on righting everything that was done poorly. But let's continue.
Rolling out new features or making PayPal a digital bank. I talked about it previously. If they copy the playbook of SoFi, I feel like PayPal could be a phoenix rising from the ashes. But instead, they're choosing to buy back shares. Now, obviously, that's a good way to reward the shareholders, but their business operations, it's still kind of stagnant. And I say all of that with concern because, honestly, their leadership team, especially their product managers in charge of all the various features and functions of PayPal, they can't be satisfied with their economic moat eroding away right now. Big tech is eating their lunch. They're doing the exact same thing that PayPal can do, but it's more integrated into their ecosystems. And so even though you might disagree with me and you applaud PayPal for using $15 billion to buy back shares, I still stand on this tiny little hill that you see on my desk that money could be better utilized for R&D purposes, in my opinion, or to initiate a dividend payment. But to just buy back the shares, I'm just...
Okay. That one I can't disagree with more. The acquisitions, I could kind of see its point. I think the dividends would be the dumbest thing that the company could do right now. It would make zero sense. Okay, cool. You pay a good dividend, but with the dividend, now you're just first off, dividends are taxed. With the dividend tax, yes, they're taxed less than your current income, but still overall, you're going to pay more in taxes for those dividends than if they just bought back the shares, increased your ownership, and you had the stock appreciate, and now you get that long-term capital gains tax. Or you can just keep deferring those taxes till you eventually want to sell. Maybe they do dividends later in the future, but I think if the stock's at this depressed level, I think it just makes so much sense to just continue the buybacks and just give back to shareholders. I don't see the point of a dividend. I really don't. I know some people like income, and obviously his channel name is Dividend Compounders of Cheese, so obviously he's more of a dividend investor, but I don't think a dividend is always a solution with extra capital. I think there are times when a dividend makes sense, but there are times like right here where I think it makes more sense. Take those shares off the market while they're cheap. As long as those shares are cheap, get as many of them retired as you can. Just keep hammering away at them. But yeah, I hope they don't announce a dividend. I think that'd be a great waste of capital. And the thing with dividends, one thing also is you aren't technically locked into the dividend per se, but it feels like the company's more locked into this is how much capital we need to allocate to this going forward. Because if they say right now, they're like, we're going to announce the dividend, we're going to take $4 billion a year paid out as a dividend. Are they going to be able to ever cut that without crashing the stock price? No, because people are going to be used and expecting, okay, they're going to start paying a dividend. If you announce you're cutting your dividend, even if the company's doing great, that stock price is going to go down as soon as the news breaks for that. As soon as it does. With these share buybacks, they announce them in blocks. They say, okay, we're allocating $15 billion. They can choose to buy back. They could choose not to. And in the future, if they say, okay, the stock's at a higher valuation, we think we can better take this $6 billion of free cash flow a year we are generating. We think we can take this and better allocate it over here. Go make an acquisition, like he was saying, in the future after they have everything good. Or we think we can take it and invest back into PayPal, maybe some more servers or anything, anything to get a return, anything they can get an internal return on. They have the freedom to do that without having the negative publicity of pulling that spending from somewhere, because people don't look at it the same. If you don't authorize another buyback program, it's not looked at the same as if you've had a dividend running for 5-10 years straight and your company decides, hey, we don't want to run the dividend anymore because we want to use it for this other growth opportunity. So that's my personal problem with it. So I think the buybacks are more flexible, and I think they just make more sense.
Here, as a matter of fact, let's look at it. So another very mature, established financial company that PayPal really reminds me of is Western Union. Western Union's in the business of transferring cash money from point A to point B. Now, if you take a look at Western Union's shares outstanding situation, for the past 10 years, they've been aggressively buying back their shares.
YouTube Premium is ad-free YouTube and exclusive access to all
PayPal is copying them play by play. 2015, Western Union had 516 million shares outstanding. Year over year, they just keep buying back the shares. Now, there's 337 million shares outstanding. Now, you would think by buying back the shares and artificially boosting their EPS and all of their other metrics, that their share price would follow suit and go to the sky, right? That's the investing catalyst thesis for PayPal right now. But if we just take a look at Western Union for the past 1 year, negative 34%. Past 5 years, negative 63%. So even though Western Union is aggressively buying back the shares, in the past 5 years, they're still down 63%. But it is worth calling out. The difference between Western Union and PayPal, take a look at their gross sale. Their revenue has been stagnant from 2015 to 2018 and then has just been steadily declining year over year. It's just dropping every single fiscal year. That's really, really bad. Whereas...
Okay. So right there, even though he kind of mentioned it there, you can't really take that. You can't just compare apples to apples like that, or compare apples and oranges, I should say. Western Union's already a declining bank. Banks typically already trade at a lower PE, just given the industry they are in. And not to mention, like he was saying, look at what the revenue did versus PayPal. And to more visualize this, I actually have it pulled up over here and ready. So right now we have the revenue. If we go back to 2015, March of 2015, Western Union was doing 5.58 billion versus PayPal 8.29. PayPal is now doing 32 billion on a trailing 12-month basis. Western Union's doing 4, doing less than they did 10 years ago. That's a declining business. You can buy back all the stock you want, but if your business is slowly deteriorating, that's not going to save you from that share depreciation. So that's just with the revenue. Now, if we switch it over to net income right here, something else you'll notice. PayPal, consistently profitable. They were doing $1 billion. Now they're doing 4.68. Western Union, the net income organically hasn't changed at all. Is this what we're seeing with PayPal? No, the net income has been increasing. 4.68, 853 million, 896, very small growth. And then also something else you got to consider. Look at these years of losses. They were actually losing money, which you got to factor that in as well. And especially in the financial space, when you start losing money, what's the most important thing in these financial spaces, these bank spaces? That trust. If you are starting to lose money, you start to lose trust. It makes it even harder to get that credibility, and your valuation's obviously going to take a hit, and you're going to trade at a cheaper valuation because people don't trust you. So when you're over here trading and you look at your net income and you're like, oh, I'm losing money, the market's not going to like that. Furthermore, now because of that, if we take a look at their price to earnings ratio side by side, we can see their portions with Western Union where they were getting extremely high in their valuation. And we can see this period where they lost money, where they're actually trading at 0. So the market is going to lose trust, especially on these bigger banks. So I just don't, just moral of the story right there. Western Union, declining business model, revenue decreasing, net income barely increased. They had periods of losses versus PayPal, consistent growth. I don't think you can even compare them side by side. I don't think you can just say, hey, look, they've both been buying back shares, and this one hasn't done anything with the share buybacks. So therefore, share buybacks don't work. I don't think it works like that. I don't think you can just factor it in like that.
On the other hand, if we pull up PayPal, the difference is that their revenue, their top line, is only growing year over year. And friends and family, a business cannot be fundamentally dying if their gross sales keeps going up year over year. Now, obviously, they're not posting the same numbers like they did in 2020 of like increasing it by like 20.7% year over year. Now it's only going up by 4%. And that's because previously I said it. I think PayPal's market penetration is saturated. So the growth in their revenue, it makes sense of why it's slowing down. But something else that you want to keep in mind is I started to look at their shares outstanding situation a little closer. And ever since 2015, PayPal has been aggressively buying back their shares. So what you're seeing is that the amount of shares outstanding is decreasing year over year. This isn't something new. Buying back the shares isn't something they just decided to do in 2025 or in 2022. As you see, in 2018, there's 1.2 billion, and then it just keeps dropping every single year. Now it's just above 1 billion shares outstanding. And you would think
Vanguard Active Fixed Income. Expert team, disciplined risk, proven results. Over 90.
By buying back the shares like that, it would have a drastic impact on their share price, right? Especially, let's just look at from 2022 to right now. I decided to pull it up on Google Charts so that I could do this feature right here. You would think by buying back the shares, their share price should go up. But did that happen? As you can see on your screen right now, as we zoom forward to the present tense, ever since they started buying back a crap ton of shares on an aggressive pace, it's still down 4.4%. So for me, that is a little concerning. So even though
I really don't think it is concerning. There's a very good quote. It is, I believe it was Warren Buffett who said it. In the Benjamin Graham. Okay. In the short term, the market is a voting machine. In the long term, it's a weighing machine. 2022 to now, you may think that's a lot of time. That really is not. 3 years for the market is really not that obscene. When I'm looking at stocks and investments, I'm looking on more of a 5 to 10 year horizon. And I think that makes the most sense because stocks in the short term will just follow the news. So I think just looking that they've been doing buybacks since 2022 till now and saying, okay, buybacks don't work because of that, I don't think that's wise. I don't think that makes sense. And a lot of times what you see happening is these stocks will have periods where they don't do anything and the business keeps improving and the stock price doesn't move. But when the stock price does move, it moves and it moves very aggressively. You can see that happen all the time. Look at how long Tesla was not moving before it made its explosive shift and went to the $1 trillion market cap back in, what was it, 2020, I want to say. You can look at the same thing. Nvidia's had the same cycles. Palantir is a very recent, or even SoFi, but Palantir, very recent example with that one. That one got all the way down to $8 a share. That stock went from 40, kept declining all the way down and bottomed out around the $8 mark. And the stock just stayed there for a decent period where it just kept declining or it stayed around the same spot. But once that turn did happen, look at how rapidly it happened. I don't know, where the stock was 20, like that. Next thing you know, it was 40, 50. Now, what is it today? I think it closed in the 170s. So what you got to realize is, especially with individual stock picking, you really can't look on a few year horizon. You need to be looking 5 years at minimum. And you got to, this was also another quote from another investor. I can't remember his name, but there was something where it was basically along the lines of, if you're individual stock picking, you should expect to underperform the market for years. But on a longer period, that's when you overperform, basically. Which is a lot of the gains you're going to make typically will come in a very short amount of time, but that doesn't mean they'll happen quick, if that makes sense. In terms of, you could find something extremely undervalued and you can continue adding to your position, and it will stay at that same undervalued spot. But eventually the market will correct it. You just don't know when. It could be a year from now. If you're lucky, it could be 2. Sometimes it takes 5+. But when it does, you could almost think of the stock market as kind of like a slingshot. It's like how I always describe it. The more it's pulled down into that undervalue, when it does shoot back up to what the fair value is, it's going to go rapidly and extremely fast. And once people realize, they start flooding in like that. So just some extra food for thought, just something to think about.
Though they have been buying back the shares at an astronomical rate, it's not really helping their cause with their share price. So the fact that their gross sales is only increasing by 4%, it makes me hesitate and feel a little cautious that, is it really going to make that much of an impact on their share price? But once again, if we take a look at PayPal's bottom line per share, it has been increasing year over year since that 2022, which, by the way, decreased 40.6%. That's a big drastic drop. That's pretty hideous and ugly. But since then, it's been going in the right direction, up and to the right. So that's what makes them very different from Western Union. Whereas their numbers are just shrinking and declining and the fundamentals are looking worse and worse, PayPal's, it's getting better. Their balance sheet is getting optimized. So that's how they're different. So even though Western Union is buying back their shares and their share price is getting crushed, and the same thing is happening with PayPal, I think the hope that I have with them is that their metrics and their numbers are improving. So I'm kind of confused as to why the market is pricing PayPal with a forward PE ratio of a 12.9. It's almost like I think the markets have it wrong with this one. So having said all of that, here's my updated game plan. I'm no longer going to just sit on the sidelines and watch them like the creep that I am. As a matter of fact, I curse you. Shame on you, because you guys did influence me. After taking a look at their share buyback program, I will most likely make the decision to buy a handful of shares of PayPal at their next dip or correction. Now, obviously, right now, they're flirting with that $70 a share territory, and one might make the assumption that it might be too late, but remember my EPS forecast, I think $75 for them, that's the worst case scenario, a very bare situation. Because for me, based on their fundamentals and numbers, I truly don't think that PayPal is a $75 a share company. And as a matter of fact, I'm going to be increasing their price forecast to $93 a share. I think that's what PayPal should be, at least in the next 365 days. And that's with their PE jumping back up to like a 17 or an 18. And that's because as of right now, believe it or not, there is bearish sentiment surrounding the company. However, if for whatever reason the narrative changes and it flips and they go back to having a trading multiple of like a 25 or 28, then obviously the price forecast goes a lot higher. But for me, realistically, PayPal right now, 69, 70 bucks a share. They should be 93 bucks. So I think that upside for me is enough to want to jump in at the right price. And that right price for me, I'm not telling anyone what to do with your money. What I'm probably going to do is, if they do in fact pull back and they drop back to like 64, 63 bucks, I'm jumping in. And I'm not saying I'm going everything into them, okay? Only a little bit. Because the upside from $64 a share to roughly 91, 92, 93 bucks, which is their inherent worth as a company, I like that upside. Now, if I can't buy into them and PayPal continues to trade flat at 69 or 70 bucks, I'm not going to be upset. It's not the end of the world. Like PayPal on my priority list right now, they're at the bottom. There's at least 30 to 40 companies ahead of them that I'm willing to buy before I want to buy PayPal. And it pains me to say, because this strategy that I just outlined that I'm personally going to be doing, it goes against my investing style. Because usually when I think about buying into a potential investment, I think about my timeline horizon as like 10, 20, 30 years. Because I'm in my mid-30s. I have time on my side. But for PayPal, it's not going to be a long-term investment because I don't feel bullish about their future based on their current operations. But if they do in fact make that pivot and transition to becoming a digital bank like SoFi, or their M&A team swallows up a very promising and bright fintech company, then obviously my opinion will change. But based on who they are right now, I'm not too bullish on the company 10, 20, 30 years from now. But for the next 1 year, not a problem. I can buy in, sell at profit, and jump out. Not a problem. So PayPal for me is...
Just personally, I don't like this thinking. I think if he's really serious about having 20 to 30 companies he likes better, why not just put the money there? Like, you don't have to buy every stock. Although I think PayPal's a good value at these prices, and I think it's a good return, you can still do well without it. You don't need any one stock. And I think if he has higher conviction plays, he can do that. I don't think it makes sense for that, especially if he already doesn't have a lot of conviction on the stock or on the turnaround. Then it really doesn't make sense, because if he's saying, okay, the stock hasn't done anything from 2022 till now, it's been basically flat, actually slightly down by about 4%. And he thinks the company already isn't doing that great and he doesn't expect it to do very great. And he's just hoping the valuation pulls up because he thinks the valuation, the fair value is a little higher at 75, which he very might be true on, or I think he said 93 for a year from now. Very well might be true. But if it hasn't moved from 2022 till now, what difference is it going to make? There's a good chance, there's always a chance that the stock still stays stagnant that entire time. I don't think that's a great chance of happening, but I also didn't think it'd still be at $60 whenever I was buying some of it, whenever I was buying some of my shares about a year ago, and I'm still buying shares. So you really never know in the short term with the market. So I don't think it's smart to just let me jump in, get some gains in a year, and then I'm going to sell out. You never know what's going to happen. So I think if he already has some higher conviction plays, I think why not just allocate more capital to those? I think that just makes the most logical sense. I just personally wouldn't do this, but I think he has one other thing at the end that I wanted to let him get through.
Is going to be a short-term rebound rally or correction in the stock price to the upside. That's it. I don't plan on buying and holding. I just don't see PayPal compounding from their own current operations. Because think about it like this. Through the share buyback program, they're making themselves look more attractive on paper, but that still does not make me optimistic of their future.
You make me wanna lose.
Does that make sense? Because instead of improving their net income through their operations, through the financial engineering, the manipulation of buying back the shares and whatnot, that's artificially boosting the EPS, which is one methodology of improving your bottom line, but the point still stands.
I really, this is more of just a pet peeve. I hate that term when people just say, like he said, like it's artificially boosting EPS in terms of the share buybacks. I don't think that's fair, because nobody says you're artificially decreasing your EPS whenever companies dilute the shareholders through the roof and are diluting like crazy. And at the end of the day, it leads to real returns or loss of returns, depending if you're diluting or doing anti-dilutive behaviors. It's a real expense. If someone's really diluting you and you own stock, you're effectively having your stock position taken away, because your ownership in that company is just going to decrease over time. Just as when people are doing share buybacks and doing anti-dilutive behavior, you effectively own more of the company, because that's exactly what it is. You own a higher percentage of the company. There's less shares outstanding. You own the same amount. Your percentage goes up. That's just how it works. So I don't like when people say it artificially does it, because nobody says that whenever companies are crazy diluting it and the stock price starts to tank because of it, whenever that eventually catches up with them, which can usually happen. Nobody just goes, oh, but it's an artificial decrease in share price, so it doesn't really matter, so it's not going to touch the stock price. No, it's going to touch the stock price. It still matters. You can say it's artificial all you want. At the end of the day, it's going to affect your returns. If anything, these share buybacks will just make it easier for PayPal if it ever goes back to its all-time highs, which I think it will eventually. It's going to make it easier to climb there, because now to go to that $300 level or whatever, instead of needing to be a, let's say 300, 400, I'm just pulling numbers out of my head, but instead of being like 300, $400 billion market cap, now to reach that same $300 level, now maybe they only have to be at 200 billion instead of 400 billion or 300 billion, whatever it was. So yeah, that's just something that bugs me a little bit, because people say it's artificial, but it has a real effect on returns. So it's like, what does that even mean? But continue.
If they were increasing their gross sales while reducing their overhead costs.
I know what they're saying. They're more talking about like the company actually producing more net income. Like, I get that, but still, especially with PayPal, they're still increasing their net income. So regardless.
And improving their margins, and that's why their net income per share was improving, then I would feel bullish. Then I'd be like, dude, this one right here, I like. But it's reducing their overhead costs, officially boosting the EPS, which is one methodology of improving your bottom line, but the point still stands. If they were increasing their gross sales while reducing their overhead costs and improving their margins, and that's why their net income per share was improving, then I would feel bullish. Then I'd be like, dude, this one.
But that's also what they're doing. Like, you look at the initiatives they're doing, all their initiatives are pushing up their margins. So he said right here, like, he'd feel better if they were doing this and this and this to increase margin. But you look at the actions they have taken. All the actions they have taken are going to have a long-term effect of pulling net income margins higher. So they're doing both of them. And just, I think he should look a little more into the investor day. And I really do think he should go back and listen to some of the conference calls. Maybe another time, or listen or read the press conference again. Just because I think Alex Chris has made it pretty clear that a lot of his focus has been on coming back more to profitable growth, higher margin growth, and getting effective sales that are going to have a positive effect on margins. So I think we will start to see that play out within next year. And I do think the growth rates are going to return. I don't think they're going to be anything insane like 20%, not thinking anything like that, but I do think we're not going to be stuck at this 4 or 5% range we've been at for revenue growth. I think next year it's going to be easier to comp numbers, as the growth has already been slower. It seems like they've gotten through the majority of the unbranded checkout and making that change. So I think that's going to stop being as much of a headwind on the business. I think it's going to start being a tailwind in terms of comparing numbers year over year. So I really do think the growth is going to start come back. Maybe it accelerates, maybe not to double digits, maybe like 8, 9%. But again, the stock price, it's trading at like a 15 PE right now, so they don't need those crazy growth rates to have the market get excited and pull the stock up. So I think we'll start to see that play out next year. And I think if they do announce something in the line of running the ads or running some ads on their platform, that's also going to be great for revenue growth, because again, they have, 500 million active users a month. That is a lot of ad data they could run. That's a lot of data for advertisers, and we've seen with a lot of these other social media companies how much money you can make off of that. So I think that in general, I don't think a lot of people, well, right now it definitely isn't factored into a lot of people's valuations. It's not even factored into mine. That's just something in the back of my head I've been thinking about, but even when I ran my valuations, it still made sense even with that not being factored in. But let's continue.
This one right here, I like. But it's through financial engineering of buying back the shares. So in the short term, I suppose I like what I see. In the long term, not so much. So it doesn't make sense for me to buy and hold. And who knows if there's ever going to be a crazy event that makes e-commerce sales go through the roof again. I remember in 2020, 2021, everybody was buying stuff online because we couldn't go into the physical retail stores. So PayPal became this unicorn, beautiful company. And I think they were about $300 a share. But ever since life went back to normal and our shopping habits as consumers are now back to normal, we're pretty much split of buying stuff in person and buying stuff online. It's no longer 100% online. So I guess it's a really long-winded way of saying I think they're undervalued and I'm willing to buy them now. But I will say this, all else being equal, I would rather double down on my Salesforce position because I also think they're undervalued right now. So it really depends on who's more undervalued at the time that I decide.
I'd say he should just go more with the Salesforce. He obviously has more conviction with it, which that's the right. We all come to different conclusions as investors. So I just think if he has more conviction in Salesforce, why not? Why not allocate more capital to that? No reason to try and spread yourself thin between as many positions as you can. diversification is what Peter Lynch used to call it. So if he has higher conviction in Salesforce, go with that one. And that's just my 2 cents, though. Obviously, he can do what he feels like.
Pull the trigger and dollar cost average. Anyways, before I sign out of here, by the way, my voice isn't always this raspy. I gotta take some cough drops after I finish filming, but I want to give a shout out, recognition, and publicly praise Soul Search for contributing to the baby diaper fund on the Amazon baby registry. I honestly cannot thank you enough, and I mean it from the bottom of my heart, because my wife has quite a few friends and family members that have been donating to the baby registry, but on my end, dude, I don't have any friends. I know I talk about it a lot, and I'm not even ashamed or embarrassed to say it. I used to have a lot of friends, but for one reason or another, I became very isolated in my adulthood, and I don't have personal social media, so nobody was contributing to our baby registry from my side of the house. So I felt really sad, but you guys are pulling through, so thank you so much, because I felt so guilty, right? My wife's doing all the heavy lifting, she's carrying the baby, and everyone who's helping us out is from her friends and family. And because I don't have anyone, I felt super guilty, but you guys have been pulling through, so I feel less shameful, and I feel really grateful. And you guys remind me that you are, in fact, my friends. So I have to stop saying I don't have friends, because the YouTube community, you guys are my friends. I'm like, yeah, dude. But anyways, if you made it to this point in the video, I love you.
That's just a really great message from him at the end, and end off on a positive note. So I wish the best for him and his family, and happy it appears he is having a baby pretty soon. So anybody watching this video, go ahead and go over to his channel. Please, I'll leave the link in the description of this video. Go ahead and just let him know, hey, congratulations on the baby, and happy for him. And that's so far all I have on this.